The moment you sign your first loan document, you become part of a machine that was never designed to let you go. This isn't conspiracy theory or financial pessimism. It's the mathematical reality of modern economic systems that have evolved over centuries to create what economists quietly acknowledge as the perfect trap. The genius of this system lies not in its complexity, but in how it makes you believe you're making progress even as you sink deeper into its web. Consider what happens when millions of people suddenly pay off all their debts. The economy doesn't celebrate this achievement, it panics. When Americans briefly increased their savings rate after the 2008 financial crisis and began paying down credit card debt, Federal Reserve officials didn't praise this newfound financial responsibility. Instead, they implemented unprecedented monetary policies to encourage more borrowing, flooding the system with cheap money until people returned to their spending habits. The message was clear. Your debt isn't just your burden, it's the fuel that keeps the entire economic engine running. The architecture of this dependency begins with a simple truth that governments and banks discovered long ago. Money itself, in our modern system, is created through debt. When you take out a mortgage, the bank doesn't hand you money from its vault. It creates that money digitally, expanding the money supply with every loan approval. This means that if everyone paid off their debts tomorrow, the money supply would collapse, triggering an economic catastrophe that would make the Great Depression look like a minor inconvenience. Your personal debt, multiplied by millions, has become the foundation upon which the entire monetary system rests. This revelation becomes even more unsettling when you understand how governments themselves operate within this framework. The United States government, like most modern nations, runs on perpetual deficit spending. It borrows money by issuing bonds, uses that borrowed money to fund operations, then borrows more money to pay the interest on previous borrowing. If the government actually balanced its budget and began paying down the national debt, it would remove trillions of dollars from circulation, causing deflation so severe that economic activity would grind to a halt. The system requires not just debt, but ever-increasing debt to function. The Federal Reserve and central banks worldwide have perfected the art of keeping you in debt without making it feel oppressive. They maintain interest rates at carefully calibrated levels, high enough to ensure you pay substantial amounts over time, but low enough that monthly payments seem manageable. When too many people start saving instead of borrowing, they lower rates to make debt irresistible. When inflation threatens to let you pay back loans with cheaper dollars, they raise rates to preserve the real value of what you owe. Every policy decision is designed to maintain what they call credit market stability, which translates to keeping the maximum number of people paying interest for the maximum amount of time. The student loan crisis exemplifies this system's predatory perfection. Unlike other debts, student loans in many countries cannot be discharged through bankruptcy. The government guaranteed these loans, removing risk from lenders and creating a moral hazard that encouraged universities to raise prices without limit. Students, told that education was the path to prosperity, borrowed amounts that would have seemed insane to previous generations. Now millions find themselves in a special kind of debt purgatory, making payments that barely cover interest while the principal balance actually grows over time through capitalization. The government could forgive these loans, but doing so would acknowledge the system's fundamental unfairness and potentially trigger demands for broader debt relief. The mortgage system represents perhaps the most elegant trap ever devised. A 30-year mortgage ensures you'll pay for your house 2 or 3 times over in total payments. But here's the truly insidious part. The tax code incentivizes keeping that mortgage rather than paying it off early. Mortgage interest deductions make debt artificially cheaper, while property taxes ensure that even if you somehow pay off your home, you never truly own it free and clear. The system is structured so that the rational financial choice is to remain in debt, refinancing whenever rates drop, using home equity lines of credit to tap accumulated value, perpetually resetting the clock on full ownership. Credit cards transformed consumer debt from shameful last resort to everyday necessity. The psychology is masterful. Rewards programs make you feel like you're winning even as you lose. Cashback, airline miles, and point systems create the illusion that you're being paid to borrow. Meanwhile, the average American household carries credit card debt that would have been considered catastrophic just 2 generations ago. The minimum payment system is particularly genius, calculated to keep you paying for decades while making you feel like you're meeting your obligations. A $5,000 balance can take 30 years to pay off making minimum payments, ultimately costing $15,000 or more. The automotive loan industry pioneered the art of perpetual payment. Cars depreciate rapidly, yet loan terms have stretched from 3 years to 7 or even 8 years. By the time you've paid off your vehicle, it needs replacement, rolling negative equity into the next loan. Leasing created an even more perfect trap: lower monthly payments in exchange for never building equity at all. The industry has normalized the idea that a car payment is simply a permanent life expense, like utilities or groceries. But the system's true genius lies in how it handles those who try to escape. Pay off your credit cards and your credit score might actually drop because you're no longer demonstrating credit utilization. Try to live without debt and you become invisible to the system. Unable to rent apartments that require credit checks or get jobs where employers review credit histories. The message is clear. Participation in the debt system isn't optional. It's mandatory for full participation in modern society. Governments have discovered that indebted populations are compliant populations. When you owe money, you can't afford to take risks. You can't quit the job you hate. You can't protest policies that harm you but threaten your ability to make payments. You can't retire when your body breaks down. The debt keeps you working, consuming, and generating tax revenue. It's a form of control more effective than any authoritarian system because it feels like personal choice. You signed the papers, you made the purchases. The cage you're in is one you built yourself, bar by bar, purchase by purchase. The inflation game adds another layer to this trap. Governments benefit from moderate inflation because it reduces the real value of their own debt obligations. But here's the catch. While inflation helps governments pay their debts with cheaper dollars, the same mechanism is carefully managed to prevent it from helping you too much. Wage growth consistently lags behind inflation, ensuring that while prices rise, your ability to pay off debts doesn't increase proportionally. Your debt payments are fixed, but everything else gets more expensive, forcing you to borrow more just to maintain your standard of living. Financial institutions have evolved from simply lending money to engineering dependency. They study your spending patterns with artificial intelligence, knowing exactly when you're most vulnerable to accepting a credit offer. They increase credit limits automatically, not when you ask, but when their algorithms determine you're most likely to use them. They've gamified debt through apps that make borrowing feel like achievement, with progress bars and congratulations messages that celebrate deeper entanglement in their web. The payday loan industry represents the bottom rung of this system, but even it serves a crucial function. By trapping the poorest in cycles of debt with effective interest rates that would make medieval usurers blush, these lenders create a warning example that makes regular bank debt seem reasonable by comparison. The existence of 400% APR payday loans makes 20% credit card interest feel like a bargain, shifting the entire frame of reference for what constitutes predatory lending. Governments don't just tolerate this system, they actively participate in and protect it. Bank bailouts during financial crises reveal the true priorities. When major financial institutions face collapse from their own reckless lending, governments rush to save them with taxpayer money. But when millions of homeowners faced foreclosure, the response was tepid at best. The message was unmistakable. The lenders are essential. The borrowers are expendable. The system must be preserved even if the people within it are destroyed. The psychological manipulation extends to how financial literacy is taught. Schools, when they address personal finance at all, focus on how to manage debt responsibly rather than how to avoid it entirely. Financial advisors, many of whom earn commissions from selling debt products, frame borrowing as sophisticated financial strategy. The wealthy, we're told, use other people's money to build wealth, conveniently ignoring that the wealthy have assets to collateralize and income streams to service debt, advantages the average person lacks. Even retirement has been restructured to maintain debt dependency. Traditional pensions that provided guaranteed income have been replaced with market-based retirement accounts that require decades of contributions to accumulate meaningful value. This shift means workers must stay employed and contributing longer, often carrying mortgage and other debts well into what should be their retirement years. The dream of debt-free golden years has become a fantasy for all but the wealthy few. The medical debt system in countries like the United States adds another inescapable layer. A single medical emergency can create obligations that follow you for life, immune to discharge through bankruptcy in many cases. Insurance companies, hospitals, and collection agencies have created a Byzantine system where even insured patients can accumulate massive debts through network gaps, coverage limitations, and disputed claims. Medical debt has become the leading cause of personal bankruptcy. Yet the system continues unchanged because every dollar of that debt represents someone's asset, someone's collateral, someone's revenue stream. The digitization of money accelerates this trap. Cash transactions allow anonymity and freedom, but digital payments create data trails that feed into credit scoring algorithms. Every purchase, every payment, every financial decision becomes part of a permanent record used to determine your future access to credit. The push toward cashless societies isn't about convenience, it's about ensuring that every economic actor remains visible and manageable within the debt system. Governments have learned to use emergency powers to protect debt structures. During economic crises, they implement moratoriums on debt collection, not to free people from obligations, but to prevent mass defaults that would crash the system. These temporary reprieves create the illusion of compassion while actually preserving the debt for future collection. The debts don't disappear, they accumulate interest, waiting to be enforced when the crisis passes. The gig economy emerged partially as a response to this debt trap, but quickly became another mechanism of enforcement. When traditional employment can't generate enough income to service debts, people turn to driving for rideshare companies, delivering food, or selling crafts online. These side hustles, marketed as entrepreneurship and flexibility, are often desperate attempts to keep up with debt payments. The platforms that facilitate gig work extract their percentage, creating new intermediaries who profit from debt-driven desperation. International development follows the same pattern on a global scale. The World Bank and International Monetary Fund extend loans to developing nations with conditions that require structural adjustments, privatization of public assets, reduction in social spending, and opening markets to foreign competition. These policies often increase poverty and inequality, making debt repayment even more difficult, requiring new loans to service old ones. Entire nations find themselves in the same trap as individual consumers, permanently indebted and increasingly controlled by creditors. The housing market has been deliberately structured to prevent most people from ever truly escaping mortgage debt. Zoning laws that restrict new construction, investment firms that buy single-family homes to rent rather than sell, and regulatory requirements that make building affordable housing unprofitable all work together to keep prices high relative to incomes. When the median home price requires a mortgage that consumes 30% or more of median income for 30 years, true ownership becomes a mathematical impossibility for most of the population. Corporate debt markets reveal how the system privileges business borrowing over personal financial freedom. Companies can deduct interest payments from taxes, making debt cheaper than equity financing. They can declare bankruptcy and restructure debts while continuing operations. They can negotiate with creditors from positions of strength. These advantages, denied to individual borrowers, show that the system could be more forgiving. It chooses not to be for regular people. The psychological toll of perpetual debt creates its own enforcement mechanism. Stress about money becomes chronic, affecting health, relationships, and decision-making ability. This stress makes people more likely to make poor financial choices, accepting predatory loans or making impulsive purchases that provide temporary relief but worsen long-term situations. The mental burden of debt becomes a physical reality, with studies showing increased rates of depression, anxiety, and even suicide among heavily indebted populations. Financial technology companies promise to democratize finance, but often just digitize old traps. Buy now, pay later services resurrect the installment payment plans that trapped previous generations, now with algorithmic efficiency. Micro-investment apps encourage people to invest borrowed money, gamifying market participation while downplaying risks. Cryptocurrency lending platforms offer yields that seem too good to be true because they are collapsing periodically and wiping out savings that people borrowed to invest. The education system itself has been restructured around debt normalization. Career counselors push students toward fields based on earning potential to service loans rather than passion or aptitude. Universities have become debt processing facilities, admitting students they know can't afford attendance because loans are guaranteed. The entire higher education ecosystem now depends on the continuation of the student debt crisis. Reform would require acknowledging that millions of degrees weren't worth their cost, undermining the credential system that sorts workers into economic categories. Even death doesn't end the debt cycle in many jurisdictions. Debts can be collected from estates, leaving nothing for heirs except the example of a life spent servicing obligations. Some countries allow certain debts to be inherited directly, creating intergenerational debt traps. The mortgage on the family home becomes a cursed heirloom, passed down with the property itself. Life insurance, marketed as protection for loved ones, often just ensures that debts get paid even after the debtor dies. The comparison between government and personal debt reveals the system's fundamental unfairness. Governments can print money to pay debts, effectively defaulting through inflation. They can restructure obligations through legislation, they can simply refuse to pay, as many have throughout history, and continue functioning. Individual borrowers have none of these options. The rules that bind you don't apply to those who make the rules, a double standard that would be comedy if it weren't tragedy. This system persists because alternatives are systematically suppressed or discredited. Community banking and credit unions that might offer better terms are regulated out of existence or bought by larger institutions. Alternative currencies that might provide escape routes are banned or so heavily regulated as to be impractical. Mutual aid societies that once helped communities avoid predatory lending are replaced by government programs that often increase dependency rather than fostering independence. The final twist in this system is how it disguises itself as opportunity. Debt is reframed as leverage, investment, and human capital development. The prison is decorated to look like a palace, with marble bank lobbies and sleek credit card designs. Financial success is defined not as freedom from debt, but as access to more of it. The highest credit scores belong not to those who avoid debt, but to those who manage large amounts of it, a perverse incentive that rewards entanglement over independence. Breaking free from this system individually requires almost superhuman discipline, and often substantial sacrifice. Living without debt in a debt-based society means accepting lower living standards, reduced opportunities, and social stigma. It means saving for years to buy things others purchase immediately with credit. It means watching others seemingly prosper through leverage, while you slowly accumulate actual wealth. The system punishes such behaviour through opportunity costs and social pressure, making debt resistance feel like deprivation rather than liberation. The mathematics of compound interest ensure that even small debts become large obligations over time. Einstein allegedly called compound interest the most powerful force in the universe, and while he probably didn't say that, the attribution speaks to a fundamental truth. When working against you, compound interest creates exponential obligation growth that outpaces most people's ability to earn. The same force that builds wealth for lenders destroys it for borrowers, a transfer mechanism more efficient than any tax. Ultimately, the reason governments want you perpetually indebted isn't just about money, it's about power. Debt creates predictable, manageable populations who must participate in the system to survive. It ensures a stable workforce that can't afford to challenge existing structures. It generates reliable revenue streams through interest payments that flow from the many to the few. It maintains social hierarchies by making economic mobility increasingly difficult. Most importantly, it makes revolutionary change nearly impossible because too many people have too much to lose if the system collapses. The trap is perfect because it's voluntary, systematic, and self-reinforcing. Each generation normalizes higher debt levels for the next. Each crisis justifies interventions that preserve debt structures, rather than reforming them. Each technological advance makes escape more difficult rather than easier. The system has evolved to close every exit, patch every vulnerability, and transform every attempt at reform into deeper entrenchment. You're not just trapped in debt, you're trapped in a system where debt has become the primary organizing principle of economic life, a reality so fundamental that imagining alternatives has become almost impossible.